part 4 of the video titled KPMG Hedge Derivatives Book or Hedging Derivatives Book. Till part 3, we covered the mistakes of KPMG as far as the cash flow hedging is concerned. And I hope those who listened till part 3 got to know the stupidity by the KPMG. But before I move forward and before I present more facts, one thing I am always certain is that the big fours are not only corrupt, rather their material which they are uploading on the social media, it is technically also not correct. I have studied enough material of the big fours, which include KPMG, Deloitte, PwC, and EY. And many times I have encountered big technical issues in these materials. If you are thinking that we are restricting ourselves towards KPMG, then you are mistaken. Because eventually we would be making a video covering Einstein and Young as well. And let me tell you, the mistake in the Einstein and Young is much more severe than you have in KPMG. So today I would like to bring in another in this part, which is part 4. I would be bringing another stupidity by KPMG. But before I showed you the guide, which is this KPMG guide, let me first take you a little bit back. There are 3 forms of hedging we have in the world. So whether you are Apple, you are Google, you are Amazon, or you are any other company, there are only 3 forms of hedging. Number 1 is the cash flow hedging, which covers the hedging of the cash flows of that company. Cash flow hedging can be done in deliverable market and can be done in the non-deliverable market. So if you are thinking that cash flow hedging is always done at non-deliverable market or deliverable market, then you are incorrect. It is the knowledge level of the treasurer that makes sure where to hedge the cash flow. Like in my case, I used to hedge my cash flows when I was a corporate treasurer in deliverable and non-deliverable market both. A very skillful treasurer understands how to hedge cash flow in the non-deliverable market. Today, you will see no book, I repeat, no book published who can give you the knowledge how to hedge the cash flow in the non-deliverable market. But it is the ability of the corporate treasurer. But if you look at this book, which is by KPMG, you will never get to know about this. Rather, I will repeat the cash flow definition: a hedge of the exposure to the variability in the future cash flows of a recognized asset or liability, or of a forecasted transaction that is attributable to a particular risk. What the hell is that? What is the risk? Where did KPMG mention the intercompany exposure? Where did KPMG mention you can hedge the cash flow in the non-deliverable market also? I challenge the partner of KPMG, rather anyone from KPMG who have made this booklet. If you really think you deserve to be a chartered accountant, you deserve to be from KPMG, then let me know. Let us discuss your definition. But what is the bloody problem? The bloody problem is no one dare to challenge these big fours. End result, they always do what they love to do. As simple as that. Now I would be raising a very pertinent point on fair value hedging. But I'm not reading the definition of the fair value from this guide. I would be reading the definition in the later stages. What the hell is fair value? Like the word defined, fair value. Guys, the big companies like Amazon, Google, Microsoft, Facebook, Apple, Cognizant, Sapient, all these companies are having non-functional currency assets or non-functional currency liabilities in the local currency books. Now, the name which I have mentioned, which is say Amazon, Google, Facebook, Microsoft, Apple, Amazon, and many, they have huge quantity of legal entities. Rather, it is important to say, pertinent to say that they hold legal entities almost everywhere in the world. Almost everywhere in the world. And majority of their legal entities have non-functional currency asset and liabilities. So before I move further, if you are thinking that the fair value hedging is all about hedging of the liability exposure, then you are highly mistaken. Because fair value hedging is about hedging of asset as well as liability exposure. But there is a big catch in the scene. And that catch is completely dependent on the corporate risk management policy. And the catch is, although very less quantity of companies, very less quantity do the fair value hedging. Because fair value hedging is highly technical in nature. You need have a model in place which would help you to get this done. And majority of the companies in India and outside India, they are running their treasury function as a cost center. Simple. So the end result is, do not expect the fair value. They are happy that the revaluation which happens at the end of the month, reported at the end of quarter, consistently losing up or eating up their PAT, which is known as profit after tax, and in turn impact EPS, which includes basic EPS, diluted EPS, and reported EPS, all three. But they never conduct the fair value hedging. So please do take a note that fair value hedging is conducted in both sides, which is asset side as well as the liability side. But a right treasurer is one who take the gross up positions. Now the gross up position means he adds the asset side to the liability side and take the total. While many corporate treasurers take the net position, which means asset minus liability, which to me is not the right approach because revaluation is going to happen together. Asset side revaluation and liability side revaluation. So net off is not justified. But if you read the definition of fair value, a hedge of the exposure to changes in the fair value of recognized asset or liability. A hedge of the exposure. What the hell is exposure? Which exposure are you talking it about? KPMG not mentioned that. The hedge of the exposure to changes in the fair value of a recognized asset and liability or an unrecognized firm commitment that is attributable to a particular risk. What kind of risk? We don't know. Because fair value hedging is done to protect the revaluation risk. But did KPMG on page number and 8 mention that? No. KPMG forgot to mention that. But those who are reading these guides, they believe KPMG is intelligent. The hard reality, they are absolutely not. As we progress, more errors on the cards. In this part 5, I would take you how fair value can be hedged in your local country and how it can be hedged in the foreign currency, in the foreign country. Both are having their pros and cons. So I don't say that the first one is right or the later one is right. But having said that, it is always pertinent to hedge fair value in global treasury centers. Now, global treasury centers means Singapore, it includes Tokyo, includes Luxembourg, Frankfurt, London, and United States. I never find it pertinent if you're hedging the fair value in local country because premiums you will never get. The local regulator restrictions make it difficult to hedge the fair value. Accounting is definitely an issue in that regards. So I don't recommend anyone to hedge fair value in the local country. But this great book by a great big four known as KPMG forgot to mention this. Common sense, because people don't have ability to pinpoint. And KPMG is very clear. Why should we bother? See you in the part 5. We speak. Part 5th of the video. And in this, we would be covering about KPMG Hedge Accounting Manual. And I would be taking you through the example of the fair value hedge. Now, what is that example? It's a live example which I'm taking. Suppose Cognizant India. Why suppose? Cognizant is having a subsidiary in India. But that works on intercompany model, which means that the actual work is done by Cognizant US, but actual contract is signed by Cognizant US, but the work is done by Cognizant India on behalf of Cognizant US, which effectively means that Cognizant India will get compensated by the parent company, Cognizant US. So ultimately, the billing is done by, or the invoice is raised by the US entity, while the work is done by the Indian entity. So which precisely means as a client. So today, Microsoft, assuming, giving some work to Cognizant. So they would be signing a contract with a parent company known as Cognizant US, or probably non-parent company also. It may be Cognizant European, Cognizant London, or maybe any other country. But the contract is with them. They will not sign the contract. They will not, this entity who is signing the contract, assuming Cognizant US, they are only signing the contract. They are not doing the work because the cost of doing the work is extremely high. Henceforth, they don't do the work. They delegate or offshore the work to the Indian entity because here it is cheap, relatively much cheaper if Cognizant will get the same work done in US. Now, the invoice entity would be Cognizant US, while the work entity would be Cognizant India. So Microsoft would be facing two counterparties. One is the invoice counterparty, billing counterparty, who is cognizant US. One is the work counterparty. If the work is not up to the mark or there are any changes in the processes or anything, pricing, COLA clause, cost of living adjustment, and many things, this will to the cognizant India. Now we need to understand very importantly that Congress in India needs to be reimbursed under the arm length transaction, which is also known as intercompany model by Cognizant US. But that funding won't be INR. That funding would be in dollars, probably GBP, probably euro, probably Swiss franc, probably Canadian dollar, probably any other currency, which all I mentioned dollar, GBP, euro, Swiss franc, Australian dollar, Singapore dollar, Canadian dollar, all these currencies are non functional currencies for Cognizant India, which creates an impact known as revaluation at the end of the month. Now, sometimes this revaluation is positive, sometimes it is not positive. And when it is not positive, it impacts the P&L, preferably speaking EPS, which is earning per share. Now, to hedge this exposure, Cognizant India is having two ways. Either they can hedge in the deliverable market, which means they hedge that revaluation exposure. I repeat, revaluation exposure, not the translation, sitting in India, or they hedge this to the global treasury center. Like I said, it is always advisable to hedge this at global treasury centers, which includes United States, Luxembourg, Frankfurt, London, who by the way is losing fast, Singapore, who is also losing fast, Hong Kong, Dubai, and many. But in terms of Asia, Singapore is still the preference because Hong Kong lost it completely because of their political disruptions and now COVID-19. So Hong Kong lost it completely. Let it be honest. Now, if you are hedging this in the global treasury centers, which I mentioned, you will get super premium. Don't go with the word super premium. You will get the premium which is beyond expectation because the kind of liquidity. It is like, suppose you hedge this exposure in Singapore. I will come give you more detail. Then you will get a lot of liquidity. Because suppose you hedge with anyone, JP Morgan, Citi, Standard Chartered, Goldman Sachs, Barclays, UBS, almost everyone you have in Singapore, almost everyone. And they will offer you the fair value hedging products. This includes non-deliverable forwards. This includes non-deliverable options. This includes non-deliverable OIS, non-deliverable FRA, forward rate agreement, and many. All these non-deliverable products have different nomenclature, which I am not covering in detail. I have already covered on my YouTube channel. You refer the video. But here, which is the guide by KPMG, did you knew or did you got to know about anything which I mentioned? And I'm at page number 9 of this guide. You would never got to know. And this suggests that how technical is the hedge accounting manuals of KPMG. How technical is the hedge accounting manual of KPMG? Millions of companies worldwide follow this blindly. Chartered accountants follow this blindly. CPA, follow this blindly. Some extent CFA, not charter, certified financial analyst follow this blindly. But are these manuals 100% correct? 100% technical in nature? I doubt that. They are not 100% correct. They are not 100% technical in nature. Henceforth, we need to agree to one thing, that the hedge accounting which is done based on these manuals is flawed. And history is witness that there are audit deficiencies done by all big fours. Whether this is EY, this is KPMG, this is Deloitte, or any other big four. The deficiencies is not restricted only to KPMG. Eventually, I would be bringing a lot of such videos in that regards. But having said that, in the next part, I would be covering about the mark-to-market piece of the fair value hedging. And you would be surprised to know that here you will again get an error by KPMG. Till now, we are at page number 10. And you would be happy that the intercompany exposure, which I discussed with you, the deliverable markets, which I discussed with you, the non-deliverable markets, which I discussed with you, to hedge in deliverable and non-deliverable market both, which I discussed with you, is completely missed in this guide. This is how exactly these guides work. And I'm always surprised. If there are people from KPMG who will feel offended, let it be honest, who will feel offended because now their hedge accounting manuals are under scrutiny, they can give me a call. By the way, I hope you are reviewing the KPMG on the Google about their latest scandal in the audit. So guys, I will repeat and let's move to part number 6 then. The largest scandal in the world is not the LIBOR scandal. It is not at all the LIBOR manipulation. Let it be honest. The largest scandal in the world in terms of money, which is still going on, let it be honest, is the mark-to-market accounting. Because 99% people of the globe, I repeat, 99% people of the globe do not understand mark-to-market accounting. Since they do not understand mark-to-market accounting, whatever they see in the financial statements, they feel it correct. Like if I give you the annual report, which is 10K of Amazon, consolidated, who have many business streams, many companies and different kind of models, and I ask you to check the hedge accounting of Amazon, it won't be possible for 99.99% of the people because it is highly complicated. What about if I ask you Google, Goldman Sachs, who is a bank? Because Amazon is not trading. They are hedger. But Goldman Sachs is trader and hedger both. JP Morgan Chase, Citi, it would be very complicated, which means so would be the hedge accounting. So if I ask you to check the hedge accounting of Goldman Sachs, you will really feel very, very complicated in that regards. But if you look at these manuals, you will feel like what the hell these manuals are talking. See you in the part 6, wherein we would be covering a very interesting thing known as hedging instrument and hedged item. See you in the part 6.